Hello, I'm John McArthur, Chief Investment Officer at Krilogy. Many of our clients ask if the stock market is too expensive today. By many measures, as shown on the following chart, courtesy of Charles Schwab and the Luthol Group, it would appear to be the case at first glance. Valuation metrics such as price to book value, price to cash flow, Shiller's CAPE ratio, and current and forward PE ratio, it certainly appears to be expensive in absolute terms in assessing data over the past 30 years. In looking at forward PE ratio, for example, the S&P is around 4,600, and the S&P 500 is currently projected to earn around $220 in consensus terms for 2022. 4,600 over 220 gives us an approximate forward PE of nearly 21. This number is certainly higher than the 5-year average near 18.3 and the 10-year average around 16.5. However, if we glance down the chart to equity risk premium in using the 10-year Treasury yield, we notice the inexpensiveness of stocks relative to bonds, broadly speaking, compared to the last 30 years. Risk to the inexpensiveness to stocks compared to bonds and looking at this valuation metric would be a significant and sustainable surge in the 10-year Treasury yield, which appears unlikely to us in the current environment. We feel that the structural, economic, and market backdrop will help prevent a persistent and robust interest rate environment beyond interest rate levels we've experienced over the last several years. For reference, the 10-year Treasury yield had been just shy of 2% pre-COVID and had been at 3.25% as recent as October 2018. At Krilogy, our portfolio construction process is built around appropriate levels of risk in conjunction with your goals and tolerance for overall risk. If you haven't analyzed your risk profile in a while, now may be a good time to meet with your advisor to reassess. Thank you for viewing our broadcast. This is John McArthur at Krilogy.